question, please ensure your phone is unmuted locally. Our first question comes from Bonnie Herzog from Goldman Sachs. Your line is now open. Please go ahead.
All right, thank you. Hi, everyone.
Hi, Bonnie.
I had a question on your guidance. You raised your underlying pre-tax income growth guidance a fair amount, but given the Q2 beat, it does imply a healthy deceleration in the second half. So I guess I wanted to better understand the drivers of this and really ultimately how much of the top line strength you now plan to reinvest versus maybe letting it flow to the bottom line. Also, are there any other headwinds we should be aware of for the second half, or is there maybe some level of conservatism baked into your updated full year guide? Thanks.
Thanks, Bonnie. Let me start with just a couple of facts, and I'll pass it over to Tracy. Firstly, I would tell you that the momentum behind our brands in the third quarter has not slowed down. It has maintained. And then secondly, we intend to invest very strongly behind the momentum that we've got. Hence the $100 million extra in marketing, which Tracy referred to in her remarks. Our job is to maintain those gains that we've got. We've gained, as I said, 12,000 new tap handles. We're working closely with our retailers to change the shelf sets to meet this new reality. We're the number one share gainer in dollars in displays. And we're going to invest behind the momentum that we've got, mostly in the Americas business unit, but also in our EMEA and APAC business unit behind brands such as Madrí. So I'll make those 2 points, Tracy, and is there anything?
Yeah.
Or there's more you want to add to that?
Yeah, Bonnie, the one thing that I would add is, the PEPS contract that's winding down. So, as I mentioned in the prepared remarks, we will see a headwind in terms of volume and revenue from that contract. We expect on a volume basis for that to have a headwind in Q4 of around 2 to 3% of our American volumes. And then just also, don't forget the sort of pricing as we lap the larger price increases, that we took last year in 2022, so we'll see that impact declining,
Thanks, Bonnie.
Okay, thank you.
Thanks, Bonnie. Our next question comes from Bill Kirk from Roth MKM. Your line is now open. Please go ahead.
Thank you. I just wanted to follow up and try to be super clear. So the guidance in the U.S. includes U.S. volume increases and rate. Is that changed just for what you've experienced year to date, or is your guidance now including those market share shifts that you've seen for them to continue in the back half of the year?
Hi, Bill. Thanks for that question. Look, I don't think we're going to break down individual components of our guidance, but I'll reiterate that we haven't seen any slowdown in momentum for our brands. One big difference is the extra $100 million versus the first half of this year, and actually also versus the back half of last year. To Tracy's point, pricing, we are and have already lapped one of the big price increases we put through last year, and we lapped the other one obviously in the fall. And we've been pretty consistent about the fact that we're expecting pricing to fall back to more historical levels of that sort of 1 to 2% range. And then of course there are some employment-related costs which we refer to in our script as well. So those are the sort of big four things which I would point you to. Next question, operator.
Thanks, Bill. Our next question comes from Andrea Teixeira from JP Morgan. Your line is now open. Please go ahead.
Thank you. Good morning. Gavin, Tracy, it seems that you're obviously embedding a strong deceleration in the second half and even accounting for the 2 to 3% headwind that you mentioned in the fourth quarter in particular. Can you comment on the underlying assumptions, perhaps for depletions as you go into the second half? And then embedding to that, you had this 5% increase in cost per hecto. I understand, Tracy, you mentioned that it's gonna actually decelerate. The inflation is gonna decelerate in the second half, which is obviously makes sense. To the extent that you can comment on the margin, and by the same token, I think it flows through not only the deceleration in top line, but also more conservative assumptions for reinvestment, if you can comment on that. Thank you.
Look, not Bonnie, sorry, Andrea. As I said, our momentum has not slowed down at all, and we're now towards the end of July. Our guidance assumes U.S. brand volume growth in the second half of the year, which implies continued share growth based on current industry trends. It does consider continued caution around the consumer and the competitive environment. Tracy referred to the PAPs winding down and price increases, and then of course there's the extra $100 million that we've got going through from a marketing point of view. So, we've factored all of those items into our guidance.
Yeah, and then just on the COGS inflation question. So, as we said, we do expect the impact of cost inflation to continue for this year, but then moderate in the back half of the year. And look, we've got good line of sight to our COGS right now, based on hedging, our contract prices and the expected cost savings. But we, again, do expect inflationary pressures to continue, particularly in our EMEA and APAC region, as we've mentioned. So from a margin expansion point of view, because of some of these factors, as well as the benefit from our efficiency projects, as we've invested more in our business around efficiencies and cost savings, and really looking at a more normalized cost of goods sold environment. In the medium term, we are expecting a margin expansion.
Mm-hmm. And when the capacity increases, I also want to make sure that we all circle on that. The 2 to 3% headwind, right, that you spoke about volumes that you aligned in this contract, it also gives you more capacity, right? So are you, together with what you mentioned, Gavin, in the beginning of your call, your prepared remarks, that you have some of the top 12 retailers in the U.S. taking on and adjusting shelf space for you, would we see that capacity flipping into your own brands, or we should wait for that to settle before we can count on that as you go into the balance of the year? Thank you.
Thanks, Andrea. It's our top. It's 20 retailers that are going to make changes in the fall reset. Some of them actually have already made those changes, and frankly, that number grows every week when I talk to our head of sales. So it's actually somewhat higher than what it was when I made these prepared remarks. From a supply chain point of view, I think our supply chain team has done an amazing job keeping up at such short notice. We always run close to full capacity in summer. So, of course, we're going to be a little tighter than normal. And so there are some distributors in some pockets where they may be out of stocks, particularly where the momentum is really strong. We've got some distributors growing 30, 40, 50% at the moment. We rebuilt inventory coming out of Memorial Day. We're doing the same now as we rebuild heading into Labor Day. And we came into the second quarter with good inventories. So I think we're doing a great job of keeping up with this unexpected demand. I think we've got the capacity to do that. And of course, when PAPs starts coming out, we will be able to replace that volume with our own brands, and it'll free up a little bit more capacity for us as we head into 2024.
Hi, good morning. Thank you. Gavin and Tracy, I'm hearing some concern from investors that there seems to be perhaps a disconnect in terms of what would have been expected from a depletion standpoint, just using the publicly available data. I have Nielsen. You guys are obviously citing Circana relative to the shipments. I think we've certainly covered the capacity point pretty well at this point, but were there any other timing factors to consider in terms of understanding why your America shipments fell below what we would have seen in Nielsen track channels from a volume growth perspective? Thanks.
A couple of points I'd make. One is that we came into the second quarter with very high not very high inventory. We came in with higher inventories than we normally did because we wanted to make sure we could supply our consumers and distributors through summer. Now, we obviously weren't planning for the current situation, but we certainly had higher shipments coming into Q2. We always run close to full capacity in summer. So, frankly, there isn't a lot of, from a shipments point of view, a significant increase possible as we operate in summer. Notwithstanding that, our breweries had a record May and June since 2019 and are functioning extremely well. So, those are the two factors that I would point you to, Vivian. From a capacity point of view, of course we don't have unlimited capacity, but we're keeping up, I think, amazingly well given the short notice of this demand shift, and we'll rebuild our inventory heading into Labor Day, and we'll rebuild inventory post Labor Day as we head towards the back of the year.
Our next question comes from Nadine Sarwat from Bernstein. Your line is now open. Please go ahead.
Hi, thank you. Good morning, guys. So last time we spoke, I know you mentioned your expectations at the time were that shelf resets could be more modest in the fall than some other brewers were expecting, but it sounds from your prepared remarks that you believe, these are going to be bigger than initially expected. So could you provide a bit more color based on what you're seeing? I know you touched on it, but the puts and takes of those fall resets and then how you're thinking of going into the spring next year. And then one more, if I may ask, in the U.S., were your on-trade and off-trade trends meaningfully different or broadly in line? And if so, a little color on that as well. Thank you.
Thanks, Nadine. I'll take your second question first. Yes, our on-premise trends were better than our off-premise trends in the U.S. As far as your shelf reset question is concerned, yes, we are in a better place now than we were necessarily thinking at the end of the first quarter. A lot more retailers have already moved some of their shelf resets and are planning to move their fall shelf resets than we had initially expected. As I said, nearly 20 of our retailers are updating their planograms right now. That number grows every week. Every time, as I said, I talk to our head of sales, that number grows. We're working really closely with our retailers to recommend space and assortment solutions to just drive a sustained category growth for the retailers. And given those recent trends, we have seen a number of retailers make interim adjustments to displays and space this summer, and we do expect that to continue into the fall and also next spring. And as I said, I think in my prepared remarks, or maybe in Q&A, I can't remember, but Coors, Molson Coors is the number one in retail dollar display gains year to date. So we're working hard at making sure that shelf resets reflect the current reality in the marketplace, which shows that there is a strong momentum behind all of our core brands.
Thanks, Nadine. Our next question comes from Filippo Falorni from Citi. Your line is now open. Please go ahead.
Looks like we may have lost Filippo from Citi. Nadine? No, not Nadine. Operator?
Filippo, if you want to, your line is now open. Please ask your question. Okay, moving on to the next question. Our next question is from Eric Serotta from Morgan Stanley. Your line is now open. Please go ahead.
sound like Eric's there either, operator.
Hello, can you hear me?
Yeah, now we can hear
Eric,
you,
we
Eric.
can hear you. Go ahead.
Oh, great. Sorry about that. Just wanted to circle back on the shipments versus depletions. Not to beat a dead horse here, but is the implication correct that shipments are expected to again lag depletions for the third quarter, and that inventory rebuild would happen largely in the fourth quarter? And do you expect shipments and depletions to still be broadly in line for the full year? Or do you think it'll take until first quarter or early next year in order for the two to converge?
Yeah, hi, Eric, it's Tracy here. So look, we're going to monitor this very closely. Obviously, our distributor inventory levels, as Gavin mentioned, over the sort of holiday periods will fall, and then, we'll grow it again. Typically, we grow on the shoulder quarters, so, the first quarter and the fourth quarter. But we're monitoring it very carefully. I mean, right now, we focus on making sure that we have enough inventory to meet the demand, and that our distributors have enough inventory to meet their demand. So, as we get further into the year, we'll continue to balance that, and again, just really focus on making sure we've got beer on the floor.
Great. And then a bigger picture question for you, Gavin. You referenced several times the weaker U.S. beer industry trend. Hoping you could unpack what you see as the key drivers there. Do you think that the situation at your competitor is having a spillover effect in terms of overall industry? We've seen the beer industry from a volume perspective weaken this year at a time when spirits volume growth has certainly slowed quite dramatically. So any color as to your take on what's driving the industry weakness would be helpful.
Sure. Thanks, Eric. Yeah, look, I mean, the U.S. industry in 2023 has been softer than expected. There are obviously a number of drivers behind that. They're on the West Coast, particularly California, big beer drinking market. We had some really difficult weather conditions in the first part of the year, and so that challenged the overall industry. And then I think it's true to say that we've had higher than expected declines in the overall seltzer segment. Our data from Circana would suggest that there's actually been a slight improvement in Q2 when you compare it with Q1, and an improvement from an overall industry point of view versus the second half of last year. We do think that some of the bigger drivers of these trends are lifestyle choices, some buyers shifting to other categories. However, core beer drinkers are incredibly loyal and have maintained their share of dollars and volume in beer. So, whilst we have seen some pretty seismic shifts across the industry, fueled by the continued growth in Mexican imports and FABs, and obviously the disruption in the ABI portfolio. Our brands, Coors Light, Miller Lite, growing industry share. So what really matters here for us is that more consumers are reaching for our beers versus our competitors' beers, regardless of the segment that they are purchasing from. So those are the comments I would have from an overall industry point of view, Eric.
Thanks, Eric. Our next question.
Good morning, everyone. So, Gavin, this may be a hard question to answer as we're still really only halfway through this year, but I would love to get your perspective on how you see the company's growth algorithm evolving in light of the share shifts we're seeing. Obviously, great to see the share gains, but you're also kind of increasing your exposure to an area of the industry where growth has been challenged for some time. And I know you had previously communicated that you expect to exit this year with stronger bottom line growth versus the low single digits originally targeted for this year. So I would just be curious, how do you think about the ability to kind of grow off of this elevated base, especially if some of these share gains prove to be less durable? Thanks.
Yeah, thanks, Peter. Look, obviously we'll share a lot more detail when we have our strategy day in October, but I'll make a few points ahead of that. You know, when we started down the journey of our revitalization plan, we wanted to deliver top and bottom line growth on a sustainable basis, not just once every now and then. So that's the first thing I would say to you. That's how we measure ourselves. Secondly, we're seeing share and brand improvement in every single one of the markets that we operate in. So this is not just the United States. We're seeing it in Canada. We're seeing it in the United Kingdom. You know, in the US, we're the number one dollar share gainer in the second quarter. Canada's up 1.5 points from a volume perspective. That's through May because we don't have more recent data than that. We grew, you know, premium lights dollar share almost 11%. Canada premium beer is up 2.4. In the FAB segment, we grew industry and the segment. We grew all of our core brands in the United States and Canada, grew industry share, and we continue to grow our economy segment performance from an improvement point of view. Our job is to make sure that we maintain and retain as many and frankly more of these consumers that are moving to our brands. It's one of the reasons we're investing $100 million more in the back half of the year. That's a significant investment and commitment to the momentum that we're experiencing. And we're seeing that in the data. We're seeing the handles, the new tap handles we're getting. We're seeing the shelf set changes. We're seeing the display dollar share gains. And we're going to push hard to maintain that and more, Peter. So, you know, I think I'll stop there ahead of our strategy day, but we'll share more with you in early October.
Thanks, Peter. Our next question comes from Lauren Lieberman from Barclays. Your line is now open. Please go ahead.
Great, thanks. I was curious of you to talk a little bit about operating leverage, because I know a couple times, you know, Gavin and Tracy, you both referenced that 2Q is normally a time when you're producing, you know, pretty close to, you know, full capacity. So as we think about the balance of the year and starting to see, you know, these structural share shifts in market share persist, if the higher volume growth, that we start to see more operating leverage kind of on a year-over-year basis because the delta is bigger in the so-called shoulder quarters than would have been, for example, in 2Q, meaning the upside in your production volume is actually higher later in the year versus 2Q because this is already a seasonally very strong volume production period.
Yeah, so maybe let me help maybe give a little bit of color and maybe a little bit more detail around our leverage and operating leverage. So on an enterprise basis, our fixed costs comprise about 20% of our enterprise underlying COGS. So now that does differ by geography, and you know, the composition of our year-over-year volume changes, it can influence that. But on average for enterprise, COGS makeup is about 20% fixed. And then obviously, you know, as we look at operating leverage, our marketing strategy also supports flexibility, which does allow us to put the right commercial pressure behind our brands. And so, you know, as Gavin mentioned, we're going to be spending $100 million more in marketing in the back half of the year. And then, you know, just from a you know, overall sort of margin driver as well, you know, we've mentioned the Pabst contract coming to an end. That's certainly going to help our margins, even though, you know, it is a revenue loss, but overall, you know, a margin expansion, as well as a lot of these efficiency projects that we've been working on, our ongoing cost savings, that's all going to help, you know, drive that margin expansion over the medium term and this year.
Our next question comes from Rob Osteen from Evercore. Your line is now open. Please go ahead.
Great. Thank you very much. Just a couple of follow-ups, Gavin. First, you mentioned that on-premise was stronger than off, but I'm not sure I heard by how much. how much the on-premise was up, and you mentioned that you won 12,000 tap handles, I think in Q2. Can you give us a sense of what that is as a percentage of total tap handles? And then second, we're seeing and hearing about some weakness in the market overall in the below premium side. Is that something that you're also seeing in your, not just in your business, but in the market overall? Thank you.
Thanks, Rob. Lots of questions there. I'll take your last one first. No, we're not seeing any slowdown in our economy portfolio. As far as on versus off premise, you didn't hear it because I didn't say it. And we're not going to get into that level of detail, but suffice it to say that on premise grew. I would say maybe low single digits better than the off premise. That was your second question. What was the third? Oh, and the tap handles. It's a meaningful number, Rob, and that's only Miller Lite, Coors Light, and Blue Moon, which I reference. And let's say, I'm not sure we've given this before, but let's say around 10% higher. Meaningful for us.
Thanks, Rob. The next question comes from Chris Carey from Wells Fargo Securities. Your line is now open. Please go ahead.
Hey, everyone. One quick question just on the investment plan for the back half of the year. Just given the year-to-date strength makes total sense. I'm trying to understand, the tight capacity relative to the investment. It sounds like you're keeping up with demand, but just have you contemplated a dynamic where this accelerated investment into the back half of the year accelerates demand, but you're not able to keep up with the demand? I totally understand the brand building for the medium to longer term, which makes complete sense. But it does sound like this is going to be supportive of perhaps even higher demand. And I'm just trying to frame how much excess capacity you might see in the system if indeed you do see a step up in line with this increased investment activity in the back half. So thanks so much for that.
Thanks, Chris. Look, our tightest period obviously is always during the summer. We always see a fall off after major holidays, just like we did in July the 4th, and we're currently rebuilding the inventory as we speak, and we'll continue to rebuild it in August, and then I'll have a fall off coming out of September, and overall consumer takeoff traditionally does fall off in the fourth quarter, so it provides us a good opportunity to get inventories back to where we would like to have them going into next year. Our marketing activities, as I said, is not just limited to the United States. We are putting more money into other markets as well, behind the momentum of a brand like Madrí, behind the Coors Light and Molson trademark brands, up in Canada, behind some strength in certain territories in our Latin America business. But it is also true to say the lion's share is in the United States. Frankly, they're at a very, very high levels, two kinds of marketing, right, and selling expenses. Some drives shorter-term behavior, which we're investing behind, and some drives longer-term brand health, and we're going to be doing both. So, as I said, we don't have unlimited capacity, but certainly Pabst coming out of our system, and then the, shoulder quarters, as I think Lauren referenced in the fourth quarter and the first quarter, give us ample opportunity to maintain inventory and supplies where we want them to be.
Thanks, Chris. Our next question comes from Bryan Spillane from Bank of America. Your line is now open. Please go ahead.
Hi, thanks, operator. Good morning, Gavin. Good morning, Tracy. I just had two sort of related questions about free cash flow. One, Tracy, if you could just talk about the 2.5 times leverage target, and just why that's a, you know, kind of a desirable target, just given how, you know, much cash flow the company throws off, and it just seems a little bit conservative. So just kind of what the thinking was there in terms of getting to the 2.5 times, and then I just had one other related follow-up.
Yeah. So, look, we did a lot of analysis, you know, what was the desirable leverage target for us to have, and we got to the 2.5 times. And, you know, remember, we've been very vocal and, you know, made sure that we maintain our investment grade rating, and over time, we want to improve our investment grade rating. And so, you know, it makes sense for us to continue to look at that leverage ratio, you know, reduce our net debt if you know, that drives us towards that upgrade in terms of investment grade. So, it's just really important to us, and so we'll continue to look at that, Brian.
Okay. And then the $1.2 billion of free, you know, or plus or minus 10%, the free cash flow guidance increase for the year. You know, I think one of the questions we're getting today is just if you were to hold on to, you know, the benefits that accrued to the company this year, would that be a normal cash flow, or, you know, were there other things like capital spending coming down, or just other things that the free cash flow conversion, you know, if we sort of rebase the company from here, could be higher, you know? So, or put another way, you know, would free cash flow necessarily, you know, be higher even for this year if there weren't some other sort of unusual things pulling on cash?
No, I mean, look, obviously, you know, capital expenditure is one of the things that we look at, but I think we've been quite consistent with our capital expenditure, and we've also said that, you know, any investments we make is not going to drive our capital expenditure up significantly. And even the investments that we've made in new breweries in Canada, you know, we've built those 2 new modern breweries in Canada. We're busy modernizing our G150 brewery in Colorado. You know, we've built capabilities in our breweries, whether that be flavor capabilities or variety packing capabilities. All of that was within that range of around $700 million, which is the guidance that we've given for this year as well. So, you know, don't see a significant uptick in anything CapEx related or anything unusual. I mean, the one thing is at the end of the year, obviously working capital will be a driver of our free cash flow, but yeah, nothing out of the ordinary.
Please go ahead.
Yes, hey, thanks, and good morning. I wanted to just revisit the capacity question in the U.S., maybe from a different perspective. I think, you know, both in the quarter and year to date, the financial volumes you shipped in the Americas, you know, lagged what you were able to ship in the first half of both 2020 and 2021. And I guess is there a reason for that? Is that reflective of capacity that you've taken out of the system at that point? And I'm thinking about it, you know, as I look to the back half, and just trying to think about a theoretical max on what you might be able to ship, and you know, using that same logic, I think in the back half of 2020 and 2021, you shipped 33 million hectoliters. Is that feasible in 2023, or is the capacity just not there?
Yeah, Steve, look, we don't have unlimited capacity, as I said, but obviously we had a strong May and June shipments, well above anything that you would have seen in 2020, 2021, 2022. Just, you know, obviously, I think I've made the point, we had higher inventories coming into the second quarter at the end of March, and you know, that might have affected you know, some of our shipments in the sort of first part of April. So there is that as well. You know, we have long had a very robust program of seasonal workers and summer temporary workers, which frankly, if we needed to, we could continue even into the shoulder quarters. You know, we traditionally haven't found that to be necessary, but in the event that it did, we could extend our summer brewery performance into the shoulder quarters. I'd also think, Steve, just to remind you that we are seeing Pabst come out, and that will free up a lot of capacity for us, and it'll free up and simplify our breweries. There won't be so many changeovers. There'll be longer runs, much more effective and efficient. And as you know, Tracy said, we start to see the benefit of that coming through at a faster rate in the second half of this year, in the fourth quarter, and then we did in the first half, and then obviously that'll accelerate even further into 2024. So, based on what we know now, we've got the capacity to supply the market demand.
Thanks, Steve. Our next question comes from Filippo Falorni from Citi. Your line is now open. Please go ahead.
Can you guys hear me okay now?
Yes, we can, Filippo.
Okay, great. Thank you. So I just want to go back to your guidance for net sales growth on a constant currency basis of high single digits. It seems like, Gavin, you mentioned the momentum continuing in Q3 in terms of Coors Light, Miller Lite. At the consumer level, you should have a little bit of financial volume kind of recovery as you ship ahead of depletions to recover the inventories. So what can you help me square, like, what are the other headwinds other than the Pabst volume coming out in Q4 that you're assuming that will kind of slow the momentum as you're expecting the second half? Any other things that we should be aware of? Thank you.
Definitely. Maybe I'll take that. So the other thing also just to note is the pricing. So, recall the impact of our pricing increases steps down in the second half of this year as compared to the first half because of the pricing that we took in 2022. And then, as we mentioned, we expect the pricing for this year to be more in the historical average of around 1 to 2% in the US. We also are a little bit cautious around the consumer, particularly in Central and Eastern Europe. As Gavin mentioned in his remarks as well. Looking at the competitive environment, and then you mentioned the contract brewing volume coming out as well. So I would say those are the big things to consider.
We have no further questions at this time. So with that, I will hand back to Greg Tierney for final remarks.
Okay, thank you, operator, and thanks to everybody for joining us today. I know if you do have additional questions or may have additional questions that we weren't able to answer today, please follow up with our IR team. We look forward to talking with you, many of you, as the year progresses, and certainly looking forward to seeing you at our strategy day in October. So with that, thank you all for participating in today's call. Have a great day.
This concludes today's call. Thank you for your participation. You may now disconnect your line.